Since the height of the COVID-19 pandemic in 2020, the global economy has not been the same. Somehow, there was a great rebound in 2021. For a moment, it seemed everything was going to be all right as the markets not only recovered, but surpassed expectations. This recovery was short-lived because in 2022, everything came crashing down. The war in Ukraine, high inflation rates, central banks around the world raising interest rates, and the stock markets nosediving. Despite all these negative indicators, we somehow managed to escape an official recession, even though many had said we were in a recession. Now, many experts are saying this year may be even tougher than 2022. Would the world economy finally slip into a recession? What should you watch out for? These and more would be answered in this video. Before you proceed with the video, please take a second to subscribe to the channel. How it started. To understand what is going on, we must first go back to where it all started in 2020. The COVID-19 pandemic dealt a severe blow to the world economy, and as recovery operations were in progress, the conflict between Russia and Ukraine made the situation worse. It's extremely difficult to precisely manage the risks due to the complexity of the global economic and financial systems. A worsening recession is a very probable conclusion. Even though many economists felt it was unlikely, this can happen if the economy experiences another significant supply shock or geopolitical crisis. According to Joe Bresuelis, chief economist at RSM, a more acute global economic shutdown may result if, for example, China's zero-COVID policies significantly exacerbated supply chain problems, or if Russia's war against Ukraine further constrained the world's oil supply. Much of 2022 was marred by rumors of a future recession, which is currently anticipated to be unavoidable in 2023. In several nations during the early months of the COVID-19 epidemic, there was a severe but brief recession. When the next recession occurs, it will be the first time that millions of working-class people will go through it. The world facing a recession. When GDP growth is negative for 2 consecutive quarters, a recession is considered to be underway. Private enterprises typically reduce production when this happens in an effort to reduce exposure to systematic risk. After an inflationary phase, a recession could arise. Then central banks boost interest rates to slow the economy and reduce inflation as inflation rises. Higher interest rates raise the likelihood of a recession, which could result in layoffs, reduced employment, and reduced consumer and business expenditure, among other repercussions of a slowing economy. Recessions are a regular part of the economic cycle, despite the fact that they may make people anxious. There are steps you can take to get ready because they don't last forever. The International Monetary Fund IMF chief, Kristalina Georgieva, said that 2023 will be tougher than last year due to the slowing economies of the United States, European Union, and China, predicting that this year's global economic downturn will affect 1/3 of the global economy. In reaction to inflation, central banks all over the world raised interest rates with a degree of coherence unseen in the previous 50 years. According to research published by World Bank, the world may be moving toward a global recession in 2023 and a run of financial crises in the emerging markets as well as developing economies, which might harm them significantly. The study shows that such interest rate rises may result in a worldwide core inflation rate, excluding energy, of roughly 5% in 2023, nearly twice the 5-year average prior to the pandemic, unless supply disruptions and labor market pressures abate. The report's model suggests that central banks may need to increase interest rates by an extra 2 percentage points in order to reduce global inflation to a rate that is consistent with their aims. If financial market stress were to accompany this, global GDP growth would fall to 0.5% in 2023. That's a per capita contraction of 0.4% that would technically qualify as a worldwide recession. However, even while it's undeniable that the world economy is struggling and may do so for some time to come, most economists and government organizations remain pretty hopeful. Getting ready for a recession in 2023. As an investor, it would be wise to be prepared for the event, given that experts and international organizations have differing opinions about whether a recession will occur in 2023 and the effects of the recession on the economy. A proactive investment plan could assist you in making the most of the prospective chances rather than reacting to it after it started. The following are some considerations you should make before investing during a recession. Do you know investors such as Warren Buffett always look forward to recession? It's an opportunity for them to buy assets cheaply. This is the time experienced investors are on the lookout for opportunities. As a result, equity investors may adopt a diversified investment approach that places a greater emphasis on larger cap companies. Smaller businesses, on the other hand, could experience difficulties with their expansion strategies, supply chains, and clientele when economic growth is weak and there are fewer sources of income. Recent increases in gas costs are being brought on by Europe's decision to stop importing Russian oil and natural gas. Even yet, we are still unsure of the full ramifications of this. This may not only impact the cost of energy, but even investments in the sector. 2022 was a good year for energy stocks. They actually outperformed all other stocks with gains as high as 50%, while other stocks were hemorrhaging. You should also consider that growth in global GDP can be considerably weaker than anticipated if energy costs increase more or the energy supply is disrupted. Note that in times of no or little economic development, larger organizations typically function better than small and mid-cap enterprises because they typically have numerous income streams, efficient supply chains, and a consistent client base, so you would be safer investing in them. Conditions to expect. Even if the economy enters a recession, certain things would not change. For one, consumers would continue to spend. Even though salaries are rising below inflation, consumers still have the ability to acquire goods and services because they have savings and credit options to cover the difference. But when credit becomes less readily available and savings decline, many analysts predict a recession. Also, the lack of labor supply would still be a factor. There is a severe lack of trained labor across the board, especially in professions like auto mechanics. Despite the fact that government's primary focus is on combating inflation, businesses continue to struggle to find the personnel they need. With these in mind, here are some measures that financial professionals advise taking to get ready for a recession. Concentrate on creating a budget and emergency fund. It's crucial to have enough money saved up so you can continue to pay your monthly obligations in the event of an unanticipated job loss or another emergency, regardless of how well or poorly the economy is doing. Since you can gauge how much money you allocate each month and on what, your monthly budget is a smart place to start. Refresh your resume. The tech and media sectors are already beginning to see layoffs and cost-cutting measures, which might be detrimental to other businesses. During recessions, there is an increase in unemployment, so you may not be able to avoid being laid off, but you can be ready. Improve your talents and make yourself more valuable to your employer. Be wise with your investments. Heading into a recession can be a favorable opportunity to buy equities at lower prices because the stock market normally declines before a recession starts and rises before the economy improves. To make sure your investment strategy is appropriate for your circumstances, you might need to re-examine it. Prioritize clearing your high-interest debt. To improve your finances, you must address your debt. Even if it takes some time, have a plan for paying off your debt. Building up your cash reserves by starting that process now will enable you to do other things, including investing in financial markets. Utilize inventive ways to save. Consider alternative strategies to increase your savings. For instance, cutting down on one or two streaming platforms to ensure you have the finest option for your unique situation could result in a yearly savings of several $100s. Silver linings. The overextension of supply chains, precarious company models, and razor-thin stocks were some of the root reasons for the 2-month recession and financial hardship in 2020. The year 2023 will be challenging for the U.S. economy as well, with businesses dependent on the dollar working to be especially ready this time for unforeseen situations. As of November 2020, multiple market indicators suggested that the market is already pricing in the possibility of a recession over the following 6 to 9 months. Meanwhile, the Indian economy grew by 8.7% in 2021, according to a World Bank report released in October 2022. It's anticipated to increase by 6.5% in the upcoming fiscal year. Despite the severe contraction during the pandemic, Indian economic recoveries have been astonishing in comparison to other South Asian countries. Major Asian nations will account for about 3/4 of the global increase in GDP in 2023, with the United States and Europe significantly reducing substantially in comparison. Can the Asian economy steer other economies away from a recession? For now, we can only hope for the best and play safe with our investment choices. For more videos like this, subscribe to the channel and be sure to give this video a thumbs up.